The Nasdaq-100 index has severely outperformed the S&P 500 since its inception in 1985. That's right, this thing has been dominating the market since your boy was 3 years old. This timetable includes multiple recessions, including the technology destroyer known as the dot-com crash at the turn of the millennium. I'm sorry, haters, we are well past the performance-chasing window on this one. I can't wait any longer. I'm adding QQQM to my portfolio. In this video, I'll explain how I plan to add it to my portfolio. We'll also analyze the entire 40-year history of the Nasdaq-100's performance. I'm excited for this one, you guys. It's the first addition I've made to my portfolio since adding JEPQ for the necessary cash flow last summer. And you know that this nerd will spare zero details. Click it or ticket, baby. Buckle in and get ready for the ride. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please rainbow kick the like button, subscribe if you haven't already, and drop me a comment down below with your thoughts about QQQM or some of your other favorite growth ETFs. We have a ridiculous 30 new channel members this week. I am nearly speechless, you guys, and that's hard to do. I'd like to give a huge shout out to all the new names on the screen and all of you that have been here all along. I hope by the time you are hearing this video that I have the portfolio tracker fully functional on Google Sheets, it's already out there in Excel, and that I've dropped the new dividend retirement scenario planner out on Google Sheets and as a spreadsheet as well. I also plan to drop the full holding details of the HODL Factory, my individual stocks that I pick with my best friend that have outperformed the market so far, and it's just over 1 year of history, out there as an Excel sheet and a Google Doc as well. I really do appreciate the extra support for the channel, you guys. Let's grow. QQQM and the Nasdaq-100 Basics. QQQM is the Invesco Nasdaq-100 ETF. It seeks to track the performance of the Nasdaq-100 index by using full replication techniques. And just a note, you're probably used to hearing about QQQ. That is the exact same investment with a little higher expense ratio. So QQQM is what Invesco came up with to compete with the other growth funds out there. It is the same thing. If you're a new buyer, you'll want to shave 5 basis points by going with QQQM. Let's hop over to my screen to check out the basics. I've pulled up QQQM on Seeking Alpha, my favorite site for researching stocks and ETFs. Link in the description below if you'd like to try Seeking Alpha Premium for 7 days for absolutely free and 25% off a first year if you like what you see. So out here, after pulling up QQQM, I'm on the summary tab. The first thing I look at is the expense ratio. Now with QQQM, it's at 0.15% or 15 basis points. That's still a little bit higher than some of the other passively managed ETFs, but it's fairly low. My hard requirement is that an ETF is below 50 basis points. And then it has 23 billion under management. QQQ, the same fund for the Nasdaq-100 that's been around longer, has over 250 billion of assets under management. So this is a popular fund that's not going anywhere. Out on the holdings breakdown, this is what I like about QQQM and SCHD and some other ones as well. The technology is still high, and I love tech, so that's great. QQQM is at 50% tech. VGT, as I mentioned earlier, is 100% technology. Blended mix within a growth section would have you at 75% tech, still heavy, but a little more exposure to communication at 16%, consumer cyclical in there at 13%, and then everything else is fairly low. Consumer defensive, healthcare, and industrials round off the ones with 4 to 6%. And these top 10 holdings, I won't read them all. They're your usual suspects here in the Nasdaq-100. All these amazing companies that produce results over many years. That's one of the reasons it's been able to crush the S&P 500. There are 100 companies in the index, 104 total holdings, and the top 10% make up almost 48%, unlike VGT, which is a touch over 60%. Okay, and to look at the dividends real quick, I did have to pull up QQQ because it has more history than QQQM for some of these metrics. But as you can see here, the trailing 12-month dividend is a juicy 11.4%, and the 3-year CAGR of the dividend dividends 11%, the 5-year CAGR is 11%, and the 10-year is 10%. This growth ETF has managed to grow its dividends nicely over the years. The Nasdaq-100 index officially rebalances one time per year on the third Friday in December. It adds and drops about 10 companies per year on average. It's very similar to how the S&P 500 naturally updates its companies as well. I believe it adds and drops about 20 companies per year of its 500. The beautiful thing about both of these indices is they'll do all the work for you. You can simply buy a single ticker, VOO or VOO for the S&P 500, or QQQM for the Nasdaq-100, and then take a nap as your wealth compounds. The Nasdaq-100 is a stock index of the 100 largest companies trading on the Nasdaq Stock Exchange, and it excludes companies from the financial sector. The Nasdaq-100 has smashed, and I mean obliterated, the returns of the S&P 500 in its 39-year history. I threw together what I think is a pretty cool spreadsheet to show a scenario of what would have happened if you dollar cost averaged in to the S&P 500 and the Nasdaq side by side over the years since its inception. I'm excited to share this one, and I'm also going to drop a copy out there, of course, for the members. Let's check it out. This is a fairly simple spreadsheet. We only have two variables that we have to enter. The beginning portfolio balance, and I put 10,000 for our example here, and the annual contribution, and I put 6,000 a year, so that's $500 per month. In order to make it accurate, and I did test myself directly against Portfolio Visualizer, so this thing works well, but I had to make it annual contributions, otherwise it gets a little muddy. So you can see here, the purple section is the Nasdaq. You have beginning balance each year, the growth percentage for that year, and the ending balance. And we're starting at 1986, which is the first full year that the Nasdaq was out there. And then the S&P 500 is the blue, and you can see here the blue results. So in the first year, the Nasdaq grew at 7%. We're pretty happy. Oh wait, the S&P 500, 19%. Whoops. So the S&P 500 is kicking butt after the first few years here. But then as we go down on the years, and we'll slowly scroll down here, and I'll let you guys pause if you would like to see year by year. But this is just that cost averaging in. These are the real results. Nothing's made up here, the indexes themselves. So it doesn't matter if QQQ and VOO and SPY, which is close, existed, irrelevant. This is the results as if they did exist. There was a low cost, way to invest in them. And as you go down, you notice the Nasdaq starts to pull away a little bit here with the ending balance. By the time 2010 hits, we're 322,000 higher with the Nasdaq. You're at 868 compared to 545. And I just picked a year there. As we keep scrolling down, sheesh, the gap is widening here. So at the end of 2023, you would have $7.6 million at $500 a month, beginning with 10K, up there in the 80s. And with the S&P 500, you would end with $2.9 million. So it's a difference of $4.75 million. And again, the Nasdaq is a roller coaster. I mean, look at the .com. We're talking about a roller coaster here. There's no doubt about it. So we're not all smooth sailing. I think that it's safe to say that if you dollar cost average in over many years and stay the course and never sell low, it's at least a good thing to mix in with the S&P 500 and the SCHDs of the world and your bonds and your cash and your money markets. It doesn't hurt to just have a little growth. Stay the course, dollar cost average in. Don't freak out when you get to situations like this. Ouch is all we can say there. But frankly, if you take a look, you still have more than the S&P did all along, even after the .com. But then just keep going, keep going, keep going, and you get down here. And eventually when it's high in retirement, if you need the value, you can roll it over to an SCHD or a JEPQ or DGRO, whatever the yield you need is, you can make it work. But I just highly recommend these growths, especially early on in your journey, and just stay the course. I would take 7.6 million over 2.9 million with the exact same amount of money put in and just a chill, sustained, hitting that buy button only over time. I wanted to share that zoomed out history of the Nasdaq-100 to prevent the performance chasing comments from pouring in. And I know there's no such thing as satisfying the dark side, but it was worth a shot. QQQM Portfolio Fit. If you're new here to the channel, let me give you the understatement of the century. I love technology stocks, and particularly the ETF VGT is my favorite long-term hold. Past performance is great and everything, but I really believe in the future of technology. I don't know what the next big thing is going to be within the sector. Like, for example, I'm not out there hand-picking AI stocks right now. Buying VGT provides me ownership of over 300 tech companies, so we're looking at one of those stop looking for the needle and just buy the whole haystack scenarios. And the hay quality is more valuable than the total US stock market's haystack. As of right now, my modern 3-fund portfolio consists of a third each of VOO for the market, SCHD for my dividend section, and VGT for the growth section. And I've made videos, you can look them up out there, that show that particular mix has outperformed the market, or VOO, for each of the last 10 years. Not the last 10 years, every single year within the last 10 years, 8 being up and 2 being down. My plan is to hold on to my 650 shares of VGT for years to come. When the growth section of my portfolio becomes underweight, because I always buy to my target allocations, I'll be adding QQQM as the new growth position to slowly bring it up to speed. While I've explained how much I love VGT, I also like the idea of multi-sector growth, like a QQQM as well, just to hedge a little bit over time. And believe it or not, QQQ has outperformed VGT over the last 20 years when we zoom way out. I have to admit, that was a little bit of an eye-opener for me. None of us, definitely not yours truly, knows what will happen in the next 20 years. But I do know that I want my modern 3-fund portfolio to have a little bit more balance in the growth section. Let's see how these monster ETFs have performed in the past. 1 to 20 year performance history. Before we build a nice balanced portfolio mix, we're gonna check out how each of these ETFs have performed on their own in a vacuum over the last 20 years. Let's go. All right, we're back out here on Seeking Alpha and I'm on the charting tab. So what I did here was I threw in a few like tickers to QQQ, and I use QQQ instead of M because it has the history. Remember, QQQM is going to perform slightly better with the lower expense ratio, but we need to be able to pull in more data. VGT is my current holding, so I have that there. SCHG and VUG are very much like QQQ and QQQM from a sector perspective. These are all about half tech and a fairly similar blend of other sectors. So this is true like competition. You'll notice I don't have XLK and SMH and SOX out there because those are completely different. I'm looking for a multi-sector diversified growth ETF to add to VGT. I chose QQQM, but I wanted to pull in some like ones just to, give you an idea of what I've been looking at, because these aren't bad options either, SCHG and VUG. And then SPY is just so you can see how the market has compared over these time horizons. So year to date, I am pretty much a moron, I guess, because mine's up 2.22%, and this is total return, whereas QQQ, the one I want to buy, is up 3.8%, and SCHG and VUG are up 7.3 and 8.1 respectively, and the market's up 6. So basically just ignore everything I say, I don't know what I'm doing. When we zoom out 1 year, because it's good to look at different time horizons, you have VGT at a juicy 29%, QQQ a much better 33%, SCHD still the king at 1 year at 35, and VUG right in the middle there at 32. So it's right there with QQQ. And the market's only up 22, so these growths have done well. And as we look at the 3 year, 34 VGT, 31 for QQQ, and SCHG is just behind at 29, and VUG is at 24, and the market at 28. So the market's competing. Here's where QQQ, and particularly QQQM, starts to get a little separation from its like peers. When you hit the 5 year mark, all of a sudden VGT is here at 142, QQQ is at 132 to SCHG's 121, and VUG's 108. Now QQQ does have that slightly higher expense ratio. The M version has a 15 basis points to only 4 and really low with this one too. I don't remember off the top of my head basis points, but that is included in these total returns, just to be clear. And then you zoom it out 10 years, and VGT tech has done well at 521%, but QQQ at 436 starts to pull away from SCHG at 326. And again, I don't know if it's better. I don't know what this means, but they have a similar sector breakdown. And QQQ, when you zoom out, just starts to vastly outperform SCHG. And VUG falls even further behind, and you can see the market's at 222. So it's been a bull market, but you might as well get the best of the bull market with these growth ETFs because you have your dividends and your market holdings, your cornerstones to balance things out. And now I'm pulling returns since 12/7/2009. And you might be thinking I'm awkwardly cherry picking data. All I did was I looked up the inception date of SCHG because it's the youngest one. So since SCHG has existed, this is what the funds have done. 1,004% for VGT, 1,013 for Triple Q. So it's actually outperformed VGT, albeit it's very close. But SCHG at 716 and VUG at 653. Just can't get past that because, again, these are similar sector breakdown. So it's not like we're comparing apples to oranges here. And the market's up a nice juicy 500 in its own right. So I just wanted to throw that out there to show just the further difference between SCHG and QQQM, because I've been bouncing back and forth about which one of these to hold because the SCHG does have the slightly holder expense ratio and they have basically the same top 10, just different percentages, like close to. QQQ just wins again. All right, and I promised you guys a 20-year look. So you can see I'm doing from 5304 to 430, that's when I'm recording this, 2024. So VGT, a juicy 1,268%. To QQQ's 1,319%. Begins to open my eyes a little. And we know the 40-year history is very juicy here too. And then you have VUG at a 754%, and the market's been 577. And SCHG again couldn't be in the 20-year, it didn't exist. But here's my two big boys, and again, this is growth. It's been a bull market for 10, even 20 years, maybe argue 40 years, but eventually that runs out of juice, right? You can only do that for so long. It's like, well, you know, you may be worth 12 million, but you got lucky over the last 52 years. Stop chasing. It's like, okay, bro. It's time to see how this new mix has compared to the market over the past 10 years. Oh, and we'll also throw in the old mix just to spice things up a little bit. 10-year backtest comparison. I'll be adding QQQM to the growth section of my 3-fund portfolio to diversify the performance in the future looking forward. But past performance via backtesting is an underrated tool for investors, especially as it pertains to passively managed ETFs. Many will parrot the classic rhetoric of past performance does not guarantee future results. Aside from the Captain Obvious and fulfilling legal requirements, past performance is a key component for making future decisions. We're gonna hop over to my screen now to see how the past 10 years have played out with QQQM in the mix. To be clear, past performance should not be the only reason you choose to add a holding to your portfolio. But understanding the trends over time is important. Okay, enough talk. Let's do it. We're out here on Portfolio Visualizer to do another portfolio backtest. I love this site. And I'll leave this one in the important links that I use in the new doc that I put out there for the members. So in this one, we're just going to be pulling the last 10 years. We've looked at a lot of history, but I just want to see, sort of my timeline. Sometimes I like to zoom in a little bit. The initial amount's $10,000 and we're contributing a fixed $1,000 a month during this duration. Reinvest dividends, of course. Display income, yes. Now here are the portfolios, you guys. Portfolio 1 is as if I'm in a split growth setup between VGT and QQQM, and the other half is still SCHD. Portfolio 2 is the one I've shared in the past because it's the one I've gone with, and that's 50% VGT and 50% SCHD. And then the market is VOO. Now remember guys, I go with a third of this this and this in my portfolio. But in order to make sure that this makes sense, we need to compare it to the market. So there's no reason to throw the market into here. We are assessing if this mix, in addition to the market, performs well enough to justify not just rolling with, frankly, the market, VOO, and there's nothing wrong with that. Mr. Buffett says 99% of us should do that. So just to be clear, I am separating them out on purpose. I know in reality, I have a mix of these two. With that said, let's go down and let's analyze this bad boy. So our portfolio 1 is the new setup with QQQ and really QQQM. It just doesn't have the history. Portfolio 2 is the old 1-2 punch we always look at, and it's basically my current 1-2 punch. And portfolio 3 is just VOO. So as you can see, you end with 319,000 with the new mix at the end of the 10 years compared to 329,000 with the old mix. And that makes sense because VGT has outperformed QQQ in the last 10 years. And then the market's lagging, as we know, to 61. So it's been a bull market. I'm happy to say that we keep our 10-year win streak retroactively alive against the market. So the blue bar here has outperformed the orange bar, and that's the new mix versus the market each of the last 10 years. And that's one of those things I always like to fire off because that's just kind of a cool stat. However, that said, so far in 2024, the market is outperforming both of these. So I'm not hiding it. I just wanted good, clean data here. But when we go down to the averages, we can see our old mix of dividend and growth performed at 15.8% over the 10 years compared to 15.3%. So we have given up a little returns by having the balanced growth between QQQ and VGT. But if you look the last 3 years, it's very close. We're still falling short. In the last 5 years, the new one's still falling short. It's been a tech bull run, and you might think, well, if you're losing at every interval, why on earth would you add QQQ? Well, you can see it's done better recently, but it's not about that. Again, this is macro zooming way out, wanting a little more non-tech protection within the growth, even though SCHD is low tech. So we're just throwing a little more balance here. It's cost us recently, but if we zoom this out 20 years, as you guys saw with the 20-year in a vacuum numbers, this one would all of a sudden look pretty good. So a lot can change. And when we look at the portfolio income, we should beat the market. Just so you guys know, when I run these, I'm looking at for the first time because I like to give you my thoughts live. So I have not done my homework when I do these things. And we are. Yep, we're separating from the market. It looks like VGT has grown slightly better than QQQ over the last 10 years, but we'll see what happens with that in the future. So the returns are very similar to get a little more diversity. Sign me up. I'm excited to see how adding QQQM to my portfolio will play out in the coming years. And I know this is a small incremental change, but it's a big deal for me. As you guys know by now, I do not make additions to my portfolio very often, and this one has been on my mind for years. There are millions of great portfolio mixes that will build generational wealth. I hope my videos are sparking your creative juices for your portfolio. You are going to reach your version of financial freedom if you keep learning more about this stuff. It's not a matter of if, it's a matter of when. Thank you for watching, and I will see you here next Sunday.